All right, good afternoon, everyone. Thanks for joining us today. Welcome to the latest in our series of webinars called Succession Planning, How to Value a Business.
No, I didn't. I just clicked it off. I was showing up up there.
We have with us today David's presentation will approximately be 50 minutes today, followed by a question and answer period at the end of the session. And this session will be recorded and made available on our YouTube channel to share with clients, to rewatch, or for those who are unable to attend today. So without further ado, take it away, David.
Oh, hi, Joe. Thank you. So I went down the list and I muted everyone who wasn't already on mute. So if there are any questions during the presentation, there's a chat box. So you can just type your question in. And then at the end, when we do Q&A, I'll unmute people, and then we'll be able to have some Q&A. If you type, and I can see the chat box here, so if you type something in the chat box about what I'm talking about, I could address it right there. But if it's coming further along, it may seem like I'm ignoring you, but it's just because I'm going to be talking about it anyway in a few slides. So how do we put a price on a business? And I can tell you, in my experience in helping people buy and sell businesses, this is one of the places where business owners make some of their biggest mistakes in really alienating people who may be an actual good buyer for their business. So I prepared this presentation today, and going to go through and talk about the process that I go through whenever I'm hired by someone to come in and do an evaluation on a business. We're going to be talking about some of the concepts and topics, and hopefully it'll help you guys be able to have some great conversations with people that you may be trying to help out who need to sell their business to move on and let the next generation come in. So who am I? If you haven't been to one of the other sessions that I did last year, my name is David Barnett, and I went to business school because I thought it would turn me into a businessman. And when I got out of business school, I realized that they were just trying to turn me into a big company bureaucrat, so to speak, a middle manager in a big outfit. So I got into the world of small businesses, and I was pretty lucky because I was able to start a career with the Yellow Pages. And when I was in the Yellow Pages, I got to go out and meet the owners and managers of small and medium-sized businesses all over the place. And eventually I left there and I started my own business, and I ended up starting some businesses, and I sold some businesses, and I shut down some businesses, and I bought some businesses. And I've got 2 children here at home with me. And right now, in the present, I work with buyers and sellers of businesses all over the world who come to me through avenues like my YouTube channel or the books that I've written that are looking for consulting help on how to buy or sell a business. So I've been working, if we go dial the clock all the way back to my Yellow Page days, I've been working with small business owners for over 20 years. I do appraisals, evaluations, help people with financing, and coach people through transactions. I used to be a full-time business broker from about end of 2008 until the end of 2011. And now I call myself a private transaction advisor because I no longer fill an agency role with either a buyer or a seller. So what that means is that my relationship with my clients is more set up in the same way that an accountant or a lawyer's relationship is with a client, and less in the way that, say, a real estate agent has a client who's a homeowner. And when we have an agency role, we represent someone, we have certain duties and obligations to that client. In my capacity today, I work with people and I do projects for them, like evaluating businesses, and that's what we're going to be talking about today. And if you want to learn more on my blog site, David C Barnett has literally hundreds of videos and blog posts all about buying, selling, financing, and managing small and medium-sized businesses. And I have an email list. So first thing we're going to do is a quick sort of base of information, and then we're going to get into the valuation process. So the number one thing is, what is a business? And so I put a slide up there, and there's 3 objects in the slide. I know some of you are on the phone and you're just listening, but there's 3 things that you need in order to create a business. It's a space, a place for the business to exist, whether it's a website or a storefront or a warehouse in the industrial park. And then there's people who actually do the work in the business. And then there's capital in the form of money, inventory, equipment, etc. And those three things operate together in a system to produce a cash flow, hopefully. Okay. So that's what a business is. And so when we are going to sell a business, we're not selling machinery, we're not selling land, we're not selling inventory, we're selling the system. And so in that, it's a system of people behaving with each other under a certain set of rules and characteristics. The system is fragile, and it's a very delicate process to hand it from one person to another. And when we do the evaluation, we consider what is in this business as far as the capital and the equipment, et cetera. But what we're really concerned about is that cash flow. And so on my previous calls, we were talking about what if the cash flow isn't great enough? What if the cash flow isn't worth as much as the stuff inside? That would be an instance where probably a business would be liquidated instead of being sold. So this definition that I'm putting on the screen here is basically what I just reviewed. So a business is a collection of assets, including furniture, fixtures, and equipment, human resources, space, and working capital, which operate together to produce a cash flow. And here's the important thing. The legal entities that operate businesses are rarely limited to the required resources. So that means there can be extra stuff within a corporation that isn't directly related to operating the business. And what is sold in a transaction may not actually contain all the assets needed. So when we sell a business, we can do it as a share or an asset sale. And depending on the form of sale and what goes from the seller to the buyer, there may not be everything that the buyer needs to run the business included there. So the buyer, in addition to buying what the seller is giving, may have to put money into something else. Okay. And this is very important. I'm going to get back to this concept as we get to the end of the slides. So we also need to work on some terminology. So that cash flow, there's two different definitions of cash flow that I'm going to be using today. The first is seller's discretionary earnings, which is the total amount of cash available to an owner-operator that works full-time. So this is your typical small business. Someone goes in there, they might write themselves a T4 paycheck, and then maybe there's profit as well on the business's income statement. So the seller's discretionary earnings is the total available money to an owner-operator. We're going to explore a little bit about how operators of small businesses do things with their cash flow to achieve ends like managing taxes and stuff like that. The other level of cash flow is our EBITDA level of cash flow. So the EBITDA level of cash flow is the same cash flow as the SDE, except it does not contain the manager's salary. So here's the difference. If I'm going to buy a business and I'm going to work there full time and be the manager of the business, I'm both the manager, so I should get a paycheck for that work, and I'm the investor, which entitles me to the profits of the business. Okay. If I'm just going to buy the business and I'm not going to work there, if I'm going to pay someone else to be the manager, then the cash flow I'm looking at is the EBITDA, because with the EBITDA cash flow, it's always lower than the SDE. The manager's already been paid. Okay. So these are going to come up a little bit in our conversation today. The SDE is the most important one, though, for small businesses that we're going to be looking at. So when I get a set of financial statements from someone, the very first thing I have to do is I have to unwind, usually, the tax management system of the current owner. I'm not a CPA. I have no fiduciary duties to Revenue Canada. I'm not interested in what people have done or what their feelings are about it. All I want to know is what really goes on in the business, or finding out the truth. So the question that I ask is, what would the cash flow look like in this business if someone had bought it 12 months ago and they were running the business by the book, meaning following all the rules, regulations, et cetera, that you're supposed to when you run a small business, because most small business people, of course, do not, right? So how would the sales be different, right? So you got a roofing company and the guy's, repairs a roof on someone's house, takes some cash and puts it in his pocket, right? I want to know about that because I want to know how the sales will be different. Would the cost of goods be different? If a contractor builds a deck on his own house, you can be assured that the cost of that lumber probably ends up in the expenses of the business, right? But it's not really an expense of the business. How would payroll be different if we took the spouse off the payroll who doesn't actually work there, right? And you guys have seen this stuff. How would rent be different? Sometimes we have a business where one entity owns a building and the operating company rents it, and the rent actually isn't related to the market value of the space, but rather it's related to how much money the owner of the building needs to pay the mortgage, if the owner of the building, for example, is the owner of the company, right? So we're going to adjust for these things. We're going to say, what is the actual fair market rent for that space? What is the actual value of the labor of the owner's spouse that they put into this business? And let's adjust these numbers so we're going to get a true story as to what really goes on in this business. And how we also have to back out certain things like the interest expenses and the amortization and depreciation, because the amortization and depreciation are non-cash expenses, and the interest is related to how the seller financed the business. And the buyer, or someone who prospectively is going to buy the business, they want to know how much cash flow is available, and then they're going to take that number and they're going to figure out how much they can afford to finance based on those numbers. So we go through this normalization process, and I'm going to give you some quick examples because it's easier to learn when we tell stories, right? So I'm going to tell you 3 brief stories about the small town dry cleaner, the backstreet bakery, and the big city food court franchise restaurant. Okay. So the small town dry cleaner, he operates from a business bought and paid for many years ago, and the owner is proud of the fact that he earns $50,000 a year in profit and wages. So this is the SDE, total cash flow to the owner manager, right? So what the owner believes is that he's got a profitable business and he works 50 hours a week for 50 grand. And the financial statements of his business are actually going to demonstrate this. On the financial statements, it's going to say that there's an income of 50 grand, or, owner's salary plus the profit is going to be equal to 50 grand. When we normalize it, though, what we have to take into account is the fact that building, if the building has value, the building has a cash flow of its own. So that building should be collecting rent, even though it's not collecting rent right now because it's in the same corporation as the dry cleaner. If that real estate should be earning $30,000 a year, then what's happening is that the capital invested in the real estate is actually subsidizing the operation of the dry cleaning place, and the expenses of the dry cleaner are $30,000 lower than they should be if we want to look at the dry cleaner in isolation from the real estate, right? So in this case, what I would be doing is I would add an expense line to the income statement called imputed rent, and then I would put an expense there of 30 grand. And what it would leave me is a business that only actually earns 20 grand. So the normalized version of this business is that it's a terrible business. It only actually earns about 20 grand a year for the owner, because he could shut down the business, rent out the location, and enjoy $30,000 a year of cash flow from the building without having to do any work, right? So he's doing all that effort just for the extra 20 grand. And this is why oftentimes, particularly in small towns where businesses have been open for a really long time, when it comes time for the present day owner to sell, they never end up selling, they end up closing down, often because of situations like this. It makes sense for them because they have no debt, but once somebody else is asked to pay for the building, equipment, etc., the cash flow just doesn't justify the investment. So let's look at the next slide. This is the Backstreet Bakery. So it operates from a leased location, so we don't have to worry about adjusting the rent here because the landlord's going to charge them the proper amount of rent. The owner works 50 hours a week. He earns $60,000 a year, and he likes the fact that this kind of business leads to hardly any personal grocery bill, right? This would be the same as any of the restaurant owners that I sometimes meet as well, because what they're doing is that every time they run to Sobeys or the cash and carry, the business ends up paying the full bill, even though part of that food goes to their home, right? So let's look at this one through the lens of normalization. So what the owner believes is that he earns 60 grand a year, but in reality, the SDE would actually be higher because there's more profit there that he could be enjoying that's ending up in the expenses of the business. So when I'm going through this process, I'm doing these adjustments to determine what this business is going to be worth ultimately to a buyer. What a banker, for example, is going to think about these adjustments is a whole other thing. I addressed some of that back in the first session that I did with you guys. So when I work with a seller, one of the things I explain to them is I'm going to try to figure out what really goes on in this business and what the true benefit is to you as the owner. And then we're going to find out what people are willing to pay for that. If there's too much of this kind of stuff going on, the illegal stuff, not necessarily, in the case of the dry cleaner, there's nothing illegal there. But if you are doing stuff to suppress your tax bill, what it's going to mean is it's going to be more difficult for a buyer to get traditional financing. And ultimately what ends up happening is the seller ends up having to finance the transaction to a greater degree than they might normally be comfortable with. So here's the third example. So this is the Big City Food Court franchise. And this one is in a leased location. They pay a high level of rent because they're in the mall food court. They have a tightly managed POS by the franchisor. So there's no under the table sales or anything like that going on here. And this owner earns $50,000 a year, he believes. And he boosts his profit by working extra hours with his spouse at night. And so this is unfortunately, one of the saddest ones that I see from time to time. But he believes his business earns 50 grand. But when I go and I do a normalization of the labor, what I have to do is I have to take into account the fact that a buyer isn't necessarily going to have a spouse willing to work for free, right? And so they're going to have to pay someone in order to do that work. And what's so sad about this is a lot of the times people believe that if they do this and they show the higher numbers, that their business is going to end up being worth more. And in fact, it's not, because a competent buyer is going to do this normalization. They're going to ask for things like the labor schedule. They're going to go and observe the business. They're going to see what's going on there. And so we actually have to reduce this profitability to take into account what a buyer would have to pay someone else in order to fill those hours of labor in the business. So if we look at that seller's discretionary earning, this is kind of a litmus test that I use when I classify these businesses. If you have a business and the seller's discretionary earnings, that's the total amount of money available to an owner operator that works full time, is less than the market rate of labor for that job. So if a hamburger restaurant manager might normally earn $45,000 and I own one of these places and I'm paying myself less than that because the business can't afford to pay me $45,000, then that would be that first category, less than the fair market rate. If I'm owning a business and I'm simply able to pay myself the exact amount that I would earn working for someone else doing the same work, then that's the second category. And I've got these labeled off. So if you're working full time in a business and you can't pay yourself what you would earn doing that work for somebody else, then it's not really a business, it's a hobby, because you're subsidizing the business with free labor. And in the second case, it's not a business, it's a job. And in the third case, if there actually is a profit over and above what somebody would earn doing that work for somebody else, now we're really starting to talk about a small business. Okay. And for you guys at the CBDC, when you meet with business owners and you take a hard look at some of these businesses and maybe you start asking some of the questions that you've seen me ask. So on an income statement, you start at the top line and you just go through them when you're talking with someone. You say, what's in here? What's in this telephone and internet? Does that include your teenagers' cell phones? Right? And you can learn pretty quickly that there's adjustments you can make that shows that maybe the business is a little bit better or a little bit worse than what is being shown on paper. And if you end up in a situation where somebody is working crazy hours and they're only bringing home 30 or 40 grand a year, then it's easy to help that person because you can explain to them they don't really have a business going. They've been working really hard to try to create something, but they haven't quite succeeded. They probably need to go and get a job. If it's in that second category where they basically own a job, well, there are certain people that are interested in that kind of thing. Usually it's because there's some kind of barrier to their employment, right? And so these ones are a little bit tougher. But if there really is the ability for this business to pay the person a fair market wage for the value of what they do every day, and there's profit over and above that, then we're talking about a real business. And we're talking about something that someone's going to want to buy. And we're talking about something that could maybe have what's called goodwill. And goodwill is the value someone is willing to pay for a business because the value of the cash flow is more than the value of the tangible things. Okay. So let's talk a little bit about methods of valuation. And then I'm going to tie this all together for us. Okay. So there are a couple of different categories that we can group these into, and they're very similar to the categories of valuation methods that real estate appraisers use. So there's market comparison. I want to compare your dry cleaner with other dry cleaners that have sold, for example. There's replacement value. What would it cost me to recreate this business, buying up stuff of equivalent value and opening up, this business? What would it cost me to do that? There's the income method. So we figure out ways of determining what kind of rate of return are required. And then there are other guidelines that different industries will have. We're going to look at each of these a little bit more carefully. So market comparison, the first thing we have to do is determine that seller's discretionary earnings. And then we have to find out what similar businesses have sold for with respect to multiples of cash flow. It's hard for lay people to do. I pay to subscribe to professional databases of data collected from business brokers. And you have to be careful where the data comes from, because when you look at a database record that says this business sold for a certain multiple of seller's discretionary earnings, it means you have to trust that the normalization of the cash flow has been done correctly. So only people with certain qualifications are allowed to create the information that even goes in the databases. And then I have access to it, and people, in the brokerage community who pay for it, have access to go in and then look at this data to compare with the subject business that we're trying to evaluate. This is also called the direct market data method. And let me give you a couple of examples, okay? So a database search may find that a small food business with under 300,000 in sales might sell for 1.29 times SDE, or 26% of sales. So these are two different metrics within the database. And when I'm evaluating a business, what I'll do is I'll look at the different methodologies and I'll get different results. And then I have to start looking at what the different numbers are trying to tell me. So an example company with a seller's discretionary earnings of 62,000 and sales of 299 would be worth 79.9 and 77.7 respectively. Anytime we have multiple methodologies that give us within 10 or 15% of the same number, it's a highly correlated response. So they really reinforce each other that this business is likely worth somewhere in that dollar range. When I say the business, what am I talking about? I'm talking about the value of the cash flow. And we're going to get into that more specifically later on. So what if these numbers were very different? What if the percent of sales gave me a much higher result than the multiple of the cash flow? It would show me that the subject business is underperforming its peers. Other people are able to make a higher rate of earnings with the same level of sales. So I can make determinations on the subject company based on how the different valuation methods give me different results. Okay. So does it matter when I go looking in these databases where the location or city of this business, these other businesses are located, whether what type of business they are, or the date of the comparison? The things that matter is simply the business type. We want to compare two similar businesses. Where they're located doesn't really matter, and here's why. A business in Toronto should have higher expenses, a higher rent, for example, but it should also have higher sales, and the same kind of margins should exist in that business in Toronto as they do in a smaller community. We also don't care when, because over the course of time, inflation causes prices and expenses to go up, but the relative ratio of these things typically remains constant over time. And so the biggest thing that is the most important thing is the industry. Let me show you why. So on this slide, we have two different kinds of businesses. We've got a small food business and a septic pumping business. And when I go into the database and look up comparatives, what I find, we've already looked at the small food business, but look at the septic business. 3.9 times SDE, or 43% of sales. So what this means is that if these two businesses, the restaurant and the septic company, both had a seller's discretionary earnings of $100,000 a year, the restaurant would only be worth $129,000, whereas the septic company would be worth $390,000. Okay, same profit, very different value. The bottom category there explains why. In that restaurant business, it's a lot riskier. There are fewer barriers to entry. There's more competition. People are more price sensitive, etc. For the septic pumping business, there's lower risk. You have less competition. It's hard to get into the industry because of all the permits, licensing, the capital requirements to get the big truck, etc. And people are less price sensitive. If you get your septic tank pumped every 2 or 3 years, if the price changes by $10 or $20, you probably don't even notice, right? So this is basically the market of buyers out there telling us what they perceive to be the risks in these industries. And we're able to see that, quite literally, the restaurant business is 3 times riskier than the septic business. That's what the buyers of these businesses have been telling us. The replacement cost is basically adding up the value of everything in a business. So we figure out what the equipment is worth, what the machinery is worth, any leasehold improvements, inventory value. If we're, looking at financial assets, we figure out if there's any reason to impair the receivables or anything like that. It doesn't take into account any goodwill. So it's basically just looking at the stuff inside the business. So an example of this would be that a sample company has $50,000 worth of equipment. They require $5,000 worth of inventory. In this case, the method gives us $55,000, just adding up the stuff. And then again, no goodwill. Oftentimes when I'm doing a valuation on a business, I'm looking at these other methodologies, direct market data method, and I'm looking at the income method, which we'll get into next. And usually the replacement cost has to come up. It has to be part of this exercise because from the buyer's point of view, they usually want to be able to borrow money and they want to know what the stuff is worth because they may be dealing with a bank that says, great, we hope that the business is profitable, but what's the stuff worth? Because they have to consider what the collateral value is going to be, right? Income approach. So this is a methodology for valuing businesses that I see abused very often, okay? And what we have to do is we have to figure out what kind of rate of return a buyer should want to be able to get out of buying a business. And when I say it's the method I see most often abused, it's because I'll see people apply this method, but they won't get the rate of return correct. They'll use a rate of return that's more closely related to stock market or financial investing or even real estate investing. So maybe if a real estate appraiser was going to evaluate a building based on where it is, they might use a 6, 8, 10, 12 cap rate to evaluate that building. And what they're doing is they're saying that, based on the market, investors are going to need a certain percentage rate of return in order to make this investment. When we look at a business, we have to think about not just, actually, here's the formula for building a cap rate. Risk-free rate plus the risk premium equals the required premium. If you go doing any research in financial investing, so stock market investing and stuff like this, the risk-free rate that they will use is based on the T-bill rate, the government rate. And then they will put in a risk premium for stock market beta and variations and all this kind of stuff that those guys do. They are looking at the retail investment market. And what we are looking at when we're looking at a business that someone's going to have to work full-time to manage is we're looking at what I call the wholesale investment market. So let's get our heads around this. If I deposit money at the bank, they're going to pay me a very small rate of return. Then they're going to lend that money out to someone who's going to buy a car. Okay. They're going to have to service that debt, collect the payments. And if the person doesn't pay, they're going to have to go repossess the car, etc. So while I'm a retail investor, when I make my deposit at the bank is a wholesale investor investing in a car note. Okay. So getting a much higher rate of return. Maybe they're charging that person 9% interest on the car loan, but they have to do the work in order to get the money to come in. When you're buying a business, that's kind of what you're doing. You're making a wholesale investment. So here are the kinds of numbers that I like to see. So a risk-free rate is more like 12%, because in the private mortgage market, you can often make an investment where you can lend someone money on a house at 60% loan to value and earn a 12% rate of return. And 60% loan to value is a pretty risk-free proposition. If they don't pay you, you can take the house, sell it, get your money back. Okay. But you got to go through all the hassle and hire the lawyer and do the work and collect the payments. And so in my world, risk-free rate is more like 12%. And then the risk premium, listen, there's no limit to the amount of risks out there that nobody ever thinks about that can kill a small business. I have seen small businesses destroyed by road work when cities decided to replace water and sewer, and it took them 8 months instead of 4, right? So the kinds of rate of returns that I like to see when I'm looking at a small business are usually starting in the 30% rate of return, and they head north from there. And so when we apply rates of return like that, a 40% rate of return works out to about a 2.2 times the cash flow. If we were going to look at a multiplier methodology. So you can see how these two methodologies relate to each other. So here's an example of capitalization method. So if we have a seller's discretionary earnings of 62%, if we remove the fair market wage of the owner at 30,000, we're left with a profit of 32. 32 divided by 0.4 is 80,000 in the case of this methodology. So the other problems or the challenges of this methodology are here on the screen. To be used effectively, number one, you have to come up with a proper capitalization rate. And then number two, you have to figure out what level of cash flow do we need to apply the cap rate to. So whether we apply it to the seller's discretionary earnings, the EBITDA, or the EBIT actually depends on the type of business that we're talking about, whether the business is intensive in capital equipment or whatnot. And then I put a question here. It says, why don't we capitalize net income or free cash flow? CBVs do. And CBVs are chartered business valuators. I oftentimes will run into people who have been talking with a CBV. And one of the things that's really important to point out is that the chartered business valuator designation, it's a professional designation for valuing oftentimes privately held businesses. In their world, what they consider a small business is a business with $10 to $15 million of revenue. And I deal with what I term Main Street businesses, which are in a completely different league. Oftentimes, when we use methodologies designed for those bigger companies, what I would call mid-market or lower mid-market companies, if we use those methodologies and we apply them to the smaller Main Street businesses, we often get an inflated number. It sometimes as much as double what the number should actually be. Why is this? Well, the larger an enterprise is, the more momentum it has in the marketplace, the more levels of middle management you're going to have within the company. So a $15 million company, even though it's maybe run or headed by the owner, is going to have all kinds of other people within it who are professional people at what they do. They're probably going to have a controller, they're going to have a logistics person, they're going to have, all kinds of managers who are really good at managing their part. And if the ownership changes, a lot of the skills needed to keep that thing going, to keep that ship sailing straight, are going to be sold with the business. And that tends to be why they can achieve higher valuations. There's less risk because the brain or human capital that helps to make that business go is carrying on with the business. It's not at all like that in Main Street businesses. Often the owner is the person who's doing every level of execution and decision-making above frontline, dealing with the customers. And so when that seller leaves and the buyer comes in, a huge amount of the intellectual capital of the business, the brain capital, the thinking capital, is leaving in this transaction. And this is why it's risky for buyers. And that perceived risk is reflected in the types of valuations that we see when we're going through this process. So Other methods of valuation, there's a couple of other methods out there. There's a really simple one where you just add up the value of the assets and you add 1 year of cash flow. There's something called the iterative discounted cash flow, where we look at future earnings that are projected out and we discount them back to the present value today. That kind of valuation methodology is seen in much bigger companies. Private equity investors would use that. Industry percentage rule, industry multiple rule, guideline methods. So the industry ones, sometimes within a given business industry, there's a certain rule of thumb that floats around. So it could be, and these are often found in industries where there's a lot of diversified private ownership. So there are a lot of independent pizzerias out there. So you might someday hear something that says an independent pizzeria sells for 3 times the monthly average sales plus the value of the inventory, or something like that, specific to that industry. Guideline methods are, again, for bigger enterprises where they compare a privately held business with a small publicly traded business. Again, it's nothing that's ever going to happen in the Main Street space. Capitalized excess earnings is where we break down the earnings of the business and we allocate the earnings to the different sort of groupings of capital within the business, and we ascribe a different rate of return for each one. Very complicated type of thing. Again, bigger businesses, we often see this in. And then the equity value is just looking at the balance sheet, which doesn't actually create any kind of reflection at all on the value of what's going on in the business. That cash flow, it just looks at the current position in that point in time. And so you can have a business that was tremendously profitable for decades that will have a huge amount of retained earnings in their equity section on the balance sheet. And now things have all, declined dramatically and they don't have hardly any cash flow. And it's really difficult for some of these owners to realize that their business isn't even worth what the retained earnings category says on their balance sheet. They've effectively lost value in their business. But because there's no stock market showing us the value of the shares of every business all the time for these little businesses, they haven't been able to see gradually this decline in value. And this is a place where a lot of sellers have a hard time accepting the fact that it just isn't worth what it may have been one day in the past when things were doing much better. So some key warnings for people who are buying and selling. Multipliers for SDE, EBITDA, or revenue vary by industry, and then they also vary again by company size. So I gave you guys an example of a small restaurant having an SDE multiplier of 1.29. Well, a big franchise with 2 million in revenue might have a multiplier of 3. So the multiplier changes by size as well as by industry. And that's why it's you have to be really careful when you use these methods to actually see that you're using data that is similar to the subject company that you're looking at. Never try to evaluate a business by using a rule of thumb. You can use rules of thumb to decide quickly if something is crazy. Okay. So if you look at a business and you determine its cash flow and you see that somebody's asking 7 times cash flow, then you can know right away that doesn't make sense. Nobody's going to pay that. If somebody wanted 7 times cash flow for a business, what they're essentially saying is that the business is so secure that for the next 7 years, nothing material will change. And so an investor can buy the business, work in the business, and if we're using SDE, work for free in the business for the next 7 years while they recoup their investment and then start making a return on their labor and money in year 8, right? That doesn't make sense. That's the kind of value you give to a building because you know that with proper maintenance and painting and stuff, a building should last for decades or 100 years even. In every case, the job should be researched by a qualified person to evaluate the business. Let me give you a few examples. So the overall average for all industries for small businesses is 2.3 times SDE, okay? So a business with $100,000 of seller's discretionary earnings would be worth about $230,000. Except in the example I gave you, that small food business, they actually sell for 1.29. So in this case, you would be overestimating the value of the business. In the case of the septic pumping business, they sell for more. In this case, 3.9. So in this, using the rule of thumb, you would actually be underpricing that business. And an insurance brokerage, Because the cash flow is so regular in an insurance brokerage, most people renew their insurance every year. They actually sell for a multiple of the commission earnings. And so in this case, an insurance brokerage with an SDE of 100 grand could actually be worth millions of dollars. And there's some special things going on in that industry. Namely, the insurance companies will lend money to people to buy them in order to secure the fact that most of the people in that brokerage are being sold their product. Okay. And the availability of capital is one of the things that pushes prices up in the small business world, if you're in an industry where there is capital available. So this number we've been talking about, okay, like the 129,000 for the little restaurant, what does that include? Well, the number is called an enterprise value, and the enterprise value includes everything that is needed to make that cash flow. So remember the bubble with the 3 blocks inside with the people, the equipment, and the capital? So once we determine the value of the cash flow, we then have to adjust or do a normalization of the balance sheet to figure out what should normally be included with this business or not. And we have to look at the sale, the method of sale. So let me give you an example. If I'm going to sell or value a lumber yard and there's $1 million worth of building supplies, okay, in a normal scenario, somebody should be able to borrow 75 or 80% of that inventory at the bank in a line of credit as a line of credit to support the inventory. Okay. So in that business, if there's $1 million worth of inventory required and I'm normally able to finance 80% of it, it means that as the owner, I have to have an equity position in the inventory of $200,000. And if we assume that there's no payables, and because normally there's payables and this figures into it as well, so that will be what we would call the normal net position in operating capital, the normal net position. So short-term liabilities and short-term assets taken into account, usually there's an amount of money that has to be contributed by the owner of the business. That normal net position in working capital is included in the enterprise value. So if we have a business that has a value of $129,000, and that business normally has a normal net position in operating capital of 10 grand, and we buy the business as an asset purchase, it means that typically we're not getting cash receivables and we're not taking over the payables either. But if we don't make the adjustment for working capital, we will end up overpaying for the business. So not only do we need to normalize the income statement to figure out the cash flow and then determine what the value of the cash flow is, then we have to take that enterprise value and we have to modify it for what is or isn't being included in the actual transaction contemplated that will actually give us the end value. And so it's a lot of work. It's not an easy top of the head kind of thing. And when you find a business that had, and you know, instinctively people will get certain conclusions. If the cash flow isn't very great and there are a lot of debts in the business, we know that the likelihood of the person selling the business and getting an amount of money to pay off those debts is unlikely, right? And so if there are a lot of there's a lot of cash flow and there are no debts in the business, basically what will happen is when we get to an ultimate selling price, the normalization of the balance sheet for the operating capital will show that the business actually contains a lot more operating capital than it would normally. So if they're not using a line of credit on the receivables, it means they've got their own money tied up in there. And that would be money that would, the part that is not part of the normal net position of working capital would end up being a surplus asset of the business. It would end up being added on top of the enterprise value. So there are mistakes that can be made in both directions. If people want to do a share sale and they don't properly normalize the balance sheet, they could end up giving away far more than they should for the asking price. Okay. So key learnings is that buyers, they're always looking for the maximum cash flow from the minimum amount of investment within an acceptable risk kind of purview, and which means this is why they're willing to pay more for the septic truck business than they will for the restaurant cash flow, because the septic pumping business is far less risky than the restaurant. And we're at the end. So that's my email address. If you haven't already, connect with me on LinkedIn. Go to my website, davidcbarnett.com, and sign up for my email list if you want to get regular emails on buying, selling, financing, managing businesses. I send out stuff all the time. And if you're interested in reading more, I've got a whole bunch of books that are out on Amazon. They're either paperback or Kindle or on Audible now. And that one that's in red there, Smarter Than a Startup, it's officially released tomorrow. So it's a brand new book of mine that is just coming out. So with that, I don't see any questions in the chat, but maybe what I'll do is I will, I don't know if I want to unmute everyone. Maybe I will unmute Joe. Joe, are you there?
Can you hear me?
Yeah, I can hear you.
Perfect.
Yeah. If anyone has a question, maybe just type it in the chat box or raise your hand. There's a raise your hand function I think you can see at the bottom of your screen.
Yep.
Everyone fell asleep. Sorry. What did you think, Joe? Were you able to follow along?
Yeah, no, it was very good stuff. I think it'd be very valuable for any small business owner and definitely helpful for the CBDCs. And once we have it, we'll be able to share it. Unfortunately, there wasn't as many on the call today as we would like, but I know they are available on our YouTube channel and we get lots of views there. And somebody may reach out with a question to you through other means, email or LinkedIn later on.
Awesome. All right. Well, thank you very much for having me back. And so far, I've talked about my first presentation was all about funding acquisitions, and the second one was about exit planning, and this one's about valuation. Are there any suggestions from any of the people watching about what we might do next time? If so, maybe we can just reach out to Joe. And yeah.
Yeah, perfect. Thanks, David.
No problem.
Thanks, everyone.
I'll stop recording, and we'll see you later.
All right, take care.